Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the show with us today to discuss all things Yellowcake is David Cates, President and CEO of both Denison Mines and Uranium Participation Corp. David, welcome on the program.
Yeah, Colin, thanks so much for having me. I'm really pleased to be here.
Well, David, I don't know if it's fair to say I think so, but nobody has a better pulse on the uranium market than yourself by the fact that you are the CEO of basically one of the largest development exploration companies in Denison Mines, and then, of course, Uranium Participation. I want to start with the spot price movement that we've witnessed over the last week. First of all, David, can you explain to our listeners that are unaware what Uranium Participation Corp has set out to do and how it works?
Yeah, Colin, thanks for that. I mean, UPC is really a unique company listed on the TSX under the symbol U. Basically what it's done is we've raised money over the years and we've bought physical uranium. So what we're trying to be is an ETF-like product. We are not an ETF. We are a corporation. You do own shares, but the company's only assets, physical uranium. So we've got equivalent of, say, 15.5 million pounds U3O8. We hold it in combination of U3O8 and UF6. UF6, just another form of uranium one step further along the fuel cycle. But the idea here is just to give investors a pure commodity play, no resource risk, no production risk, no developer risk, just a straight call on the price of uranium and straight pure commodity exposure to it. So you're right, we do follow the market maybe a little bit more closely than an ordinary mining company would, because in UPC, we've got one asset, it's uranium. So we want to know what's happening to that commodity all the time, inside and out, and we've certainly been watching what's happening in the spot price.
And now, David, how does one such as Uranium Participation Corp legally store and logistically store 15 million pounds of U3O8 and UF6?
Right, that's a great question. Not just anybody could set up a company to hold uranium. It is regulated, and you do have to have relationships within the industry. So that's where Denison comes into the mix. So Denison acts as the manager for Uranium Participation Corp. We have a contract, it's a management services agreement, and we get paid a fee to be the manager. But what's happened is Denison over the years, and we've been the manager since inception, has used our relationships and our network and our credibility in the uranium market to set up accounts at the proper storage facilities. And so UPC and Denison working together, we're storing all of this UPC material at facilities that exist throughout the nuclear fuel cycle, converters, enrichers, fabricators even, where they have registered, licensed storage facilities, and we're holding our material in those facilities.
Fantastic. Okay, so David, last week on December 6th, Palisade Research, which is a component of Palisade Radio, put out a piece saying that we thought the bottom was in for uranium and the uranium stocks. Part of the reason that we decided to make that call is because Uranium Participation Corp at the time was trading at a premium to the spot price. Let's start by talking about the spot price, which is now up 19 or 22% in the last week. What are you guys seeing going on with that kind of violent move?
Yeah, we've been watching it very closely, literally twice, three times a day, because it really does drive UPC's story. What we've seen is basically what we've been calling for all along, which is utility buying activity driving the market. You know, of course we market uranium nonstop between UPC and Denison, but the question is always, what's the catalyst going to be? What can investors look for to turn the space? And we've always said it will take buying activity from the utilities, because this uranium market, it's really not a regular commodity market. It's a lot of one-to-one. It's all one-to-one trading. It's really quite a thin market, and that's why we saw the price so soft, is because there really weren't buyers, and so now it was a race to who could cut their price fast enough to solicit or encourage someone to come into the market. What it's going to take for this market to really fix itself, and what we've seen in the last week, is actual utility buying. The spot market's been hot because we've actually seen up to, say, 7 utilities in the market looking for spot material. And what that's doing is what we've said always needs to happen, which is a real price discovery exercise occurring. You can't say $18 is the price of uranium when there's one buyer or no buyer and a few sellers, right? What you need is a little bit of a competitive landscape. You need buyers out there saying, look, I need to buy material, and sellers saying, well, look, I can't really sell you the material at that price and run a business, so let's find a price where we can actually transact. And that's what we're seeing in the last week. Utilities are in the market, and sellers are saying, okay, well, look, you need to buy it. Well, here's what I need to sell it for, and the price just keeps rising. Because even at $20 or $22, it's not a sustainable price for our space. It's still a very low value.
Most investors have access to the uranium spot price on a weekly basis, and therefore many investors probably don't even realize that it fluctuates and priced on a day-to-day basis. How do you track the price of uranium on a daily basis?
Yeah, to be honest, I get 3 reports every day from different brokers in the market that are pricing the bid and the ask in the uranium space, and that's how we've been watching this move. And you're right, a lot of investors won't really see it probably until Monday night or Tuesday next week when the weekly price comes out that the price is actually up 23% or plus 20% from where it was at the bottom of the market and even from the beginning of this week, right? So there is a bit of a knowledge or kind of information imperfection there, where the daily bid and ask is something that if you're in the industry and you're paying attention, you can see that it's moving before sort of the weekly updates come out.
So this all leads to a question that I asked you before we hit record, and I found your answer to be quite interesting. The uranium spot price is up, as you said, 20 to 23% right now in the last week. And sure, the uranium stocks have moved up. Cameco, in fact, started moving up at the beginning of November quite significantly. But over the last week, we haven't really seen a move in the uranium stocks as one would expect from a 23% move in the spot price. I mean, if gold moved up 23%, the stocks would be up 200-300%. Why do you think that might be?
Yeah, I think there's a little bit of a catch-up to happen, particularly at Uranium Participation Corp. I mean, we're trading basically at the same level we were at the beginning of the week. The underlying commodity is up significantly, like we said. But I think a lot of that might have to do with the fact that this price is not digested. Through all of the analysts and research notes that we get, it was only in the last day or so that we've actually started to see a few notes come out actually identifying that the uranium price is up as much as it's up. And it's been going up all week. So I do think there's a lag, and I think some of these uranium stocks could be up for a further bump next week when the broader markets see that the weekly price is actually up significantly. It's one thing to see sort of $1 up each day. It's impressive. We're all very excited about when we look at the daily price. But when you add it up, it's going to be like a $3 or $4 increase on the weekly price. As a percentage, that's dramatic. It does start to suggest that we're seeing a legitimate change in the uranium market, and it might just be what the investors really need to see. Is it all in one take? From Tuesday to Tuesday, it's gone from $18.75 to $22. That's something you have to pay attention to.
David, you've indicated that $18 was an artificial price based on little to no trading on the spot market, which makes a great deal of sense. And therefore, probably the bottom is behind us. But I want to explore what type of a move or potentially bull market that we're going to see unfold, because uranium was a curious commodity in 2016 in that it essentially dropped in half while most other commodities were up, and up significantly for that matter. Do you think that we are going to see what one could call a V bottom, where the uranium price quickly over a few months goes back to a reasonable level of $30 or $35 a pound?
Yeah, it's interesting. I do think that we're going to see a legitimate correction happen pretty quickly, but I don't think we're going to see the grand slam correction happen overnight. And so I want to answer this in two parts. we're at 18 bucks. It's so low. It's so artificially low. And then now we're in the mid, low 20 range. That's fine. But when we were at 18 bucks, it was so artificially low. You had to believe that there would be an immediate snap at some point. And you can look to what happened in the oil market, similar timing last year, where we were catching the falling knife as the oil price was dropping, and was everyone trying to guess the bottom. And we tested a bottom, and then the market for oil came back up, and we got into that $40 to $50 range. You could describe that as one of those V-type adjustments, right? Because we went from 25, up to say $50 on the oil side. We could have that happen quite easily, going from 18 to 36. We were at, in the low 30s at the beginning of the year in 2016. So there's no reason why that couldn't happen. But then you got to look a little bit beyond that and say, $36 uranium is still not a fix. Right? When we look at the global supply-demand picture, $36 uranium doesn't get the job done from a supply-demand, incenting new mine production on to fill that gap in the next 10 years. It doesn't get it done. And these uranium mines don't build themselves overnight. So we really do have potential for an even further appreciation. And if you go back to like 04, 05, those years were good years. And they happened before we saw the price go crazy in 06 and 07. And there's really money to be made on that whole journey. So I do think there's potential for a V in the near term, but I think there's potential for a much larger return as we look out like 2, 3, 4 years.
I don't want to ask you for a exact price prediction on uranium in the future because it's such an erratic commodity and how the prices can move. As you pointed out, after 2004, the uranium price spiked, I believe, to about $160 per pound, and then found its all the way back down to 18. It's quite extreme. But looking at that cost curve chart, I've heard a number of $60 thrown around the last few years being the cost that is needed, or the price of uranium that's needed to justify average global production. Is there any truth in that number? And as an extension of that, what price do you expect uranium spot to go to fix this problem?
Yeah, no, it's a great question. I think the cost curve is the right way to think about it. We look at this global cost curve. The guys at UxC put this out, and we subscribe to that report. Let me give you some data points maybe, and then sort of set up the discussion. If you look at 2016 demand, which is just shy of 200 million pounds in the grand scheme of things, and you chart that on this global cost curve, you'll cross the cost curve, and this cost curve is on an all-in basis, so capital and OPEX on a per pound basis. You'll cross the cost curve if you're using 2016 demand just shy of $40 per pound. Okay, that's break even. So if you really think that you're going to meet that demand in 2016, you got to believe that there's a rational case that the price be some meaningful amount above $40. If you also plot on this chart 2025 demand, and I think that's a reasonable year to use. It's 10 years. It's not even 10 years out, but about 10 years out. But it's when we really see a pinch happening on the supply-demand side because there really just aren't that many projects lined up to come to the market. When you plot that on, you cross the all-in cost curve just shy of $50. And so that's, again, your break even. So is it believable that the incentive price needs to be in the 60s to be able to actually bring that kind of production in the market? I think it's entirely believable. But realistically, it could go anywhere because the uranium market's insensitive on the buy side to what the price is. The utilities need pounds. They don't necessarily aren't affected the same way as other commodities in terms of what they pay for the pounds. It's a very small part of their overall cost equation. And so the most exciting thing about this market is what happens when it's tight and nobody's built mines to fill that gap. I might be able to say a reasonable incentive price is in the 60 to 70 range, but an expectation for where the price could go is a different proposition, because if there isn't material out there, and if the utilities can't get it and the miners can't mine it, then you could have a price target that's way higher than that, because literally they'll be fighting for extremely scarce material. So, if you ask me sort of on a 3-year basis, I think we can see the spot price easily be north of $40 I think that's easy to believe, but I think you could see, if we get into one of these runs, you could easily see the spot price be in the 60 or higher range in a short horizon, because the utilities will be fighting for material that they're going to need in future years. And there's really potential for the same sort of rock and roll price performance that we saw in 06, 07, where you could have $100 uranium again. That's what's been set up, because there's really no pipeline, very few projects in the pipeline to actually fill a looming supply-demand gap. And that's, great for investors to see that that's happened. It's not so great for the utilities, but I really think that potential does exist. So I think you could see prices go crazy.
What sort of chances do you give for us experiencing all new time highs in the spot price of uranium? Nobody would have imagined uranium going from $7 a pound up to $160 from 01 to 07, but it happened, and we're starting here at $18 a pound. So any chance we get an all new time high?
Well, I guess anything's possible. I don't know. Look, we'd all be doing really well if we get anywhere close to the previous all-time high. So I don't know that we care if we set an all-time high on this run, but anything's possible. I would never shoot that down.
Okay, well, I want to talk about the uranium price action that's led to where we are at now. Using hindsight and looking back towards the Fukushima disaster, that was obviously what triggered this fall off in the price. Have you guys over at Uranium Participation Corp been able to really get a pulse on the market? Because I think it's a very obscure and difficult market to identify exactly the surplus of uranium that's out there. Certainly for an investor like me, I have no way of possibly figuring out how much uranium is sitting around and what strange governments of the world are stockpiling or selling uranium. So how comfortable do you guys feel that there is not a huge surplus left?
Yeah, well, that's not any easier for even an insider in the industry. We were buying uranium earlier this year. We raised just north of $20 million in UPC in October, and we went out and bought about half a million pounds uranium. So we do have some pretty good intel right now. But in the grand scheme of things, the market is oversupplied in general terms right now. There is sort of an unloading of what I'll call secondary supplies or secondary inventories that's happening where utilities are picking up those inventories. So you've got, call it government inventories or other inventories held in traders, other sort of non-core player hands that is unloading, creating a general softness in the market. And that's why we saw the price, basically decline to that $18 level. It's all logical. It's logical, right? There was more material in the actual spot market than buyers had demand for, but it is still pretty opaque in terms of the grand scheme of things. How much of that material is out there is excess. What I'll say, though, is that a lot of the numbers that have been thrown around, they're very dramatic, but I don't think they're fair to lean on, because some of that material is not coming into the market. Right, the Chinese have a large inventory, but it's not really that large when you look at the growth of nuclear reactors in that country. Some people have said 10 years of inventory. Well, it might be at with today's fleet, but they're increasing their build program year over year. It might end up being 3 years of inventory, which is totally a reasonable balance. Japan, there's inventory there, but Japanese material is not coming into the market. So when you look at that sort of bucket of secondary supplies, you can get carried away with how big the number is. The question is how much of that can actually come into the market or will come into the market. And I'm not so sure that there's much there, and that's probably why we're seeing the spot price move now, that we've got a little bit of real demand, because I don't think there's this massive amount of material that can enter the actual market. So that's kind of the best of our info right now. Big picture, there's definitely a supply deficit. The building out of China, India, Korea, and the Middle East, whether it be UAE or Saudi Arabia, not to mention the Russian building, and now potential for nuclear expansion in the U.S. with the Trump administration. That's really going to drive the story, because the demand on the horizon is real, and the supply side is not increasing, it's decreasing. And so we are really quite confident that there is a supply shortage on the horizon. We look at the 2020s, starting as early as 2020, 2021, but really being a fundamental gap by the mid-2020s. And again, it seems like that's a long way out, but you can't fill that gap overnight, and the utilities aren't buying in 2025 for 2025, right? They're buying on 8, 10, 12-year contracts. So that reality of a gap in 2025 could really hit the market within the next 3 years.
You had indicated that the 2016 demand looked to be about 200 million pounds of uranium, indicating about a $40 break-even price for production. Looking out just a few years, say 2020 or 2025, what's the global demand looking like?
Yeah, Colin, we're looking at those numbers all the time, but basically 2016, you're just on the short side of 200 million pounds. You're about 185 million pound range, and then when you go out to say 2025, you're call it 205, 210 million pounds. So there's an increase there, and it really ramps up after 2025 as a lot of those Chinese reactors come into the market. But we're estimating, when you look at it kind of on a big picture level, about 3% annual growth. We're on the demand side. That's what we're normally modeling.
David, I think it's worth having a discussion about Denison Mines. You're the president and CEO. In full disclosure, I am a shareholder. Denison is the preeminent developer of uranium, at this point focused on Canada. Can you give our listeners who are unaware just a basic overview of Denison Mines?
Yeah, absolutely. I mean, Denison's got a long history in the uranium business, and we've really transformed the company. So the company that during the last cycle was a global uranium player, assets operating in the U.S., assets in Africa and Mongolia. Since then, and really post Fukushima, we've kind of changed our direction to be a Canadian-focused company. We do see the Athabasca Basin as the best jurisdiction in the world to be a uranium developer. They've got high-grade, large-scale assets that Cameco has shown can make it in even difficult markets, and that's really what we're trying to do with our company. We've been smart about the way we've transitioned our company. You may know that we've spun our African assets out into a company called GoviEx Uranium, also traded on TSXV GXU. That's a smart strategy. It's a different investment proposition, but we haven't sold out on those African assets. We still think there's a tremendous amount of leverage there, so we're holding a share position in GXU. But really we've done that so that the Denison story can focus on the Athabasca Basin, and in particular the eastern side of the Athabasca Basin. And I'll elaborate a little bit on that. What we're set up to do with this company, and what our mission is to become the next uranium producer in the region. When you look at the landscape of uranium companies, if you're an investor, you start at the top with Cameco, say $5 billion producer. If you drop down and look for the next producer that you can actually buy on the stock market, you drop down to basically Paladin, which is, call it $200 million with assets in Africa. There is no producer between the two. Uranium One is gone. It's been bought by the Russians. There is no intermediate producer. And we think we've got the asset base to do that because of where we're located and because of the asset. Our flagship is called Wheeler River. This is a property that we're 60% owner on. Our partner there is Cameco at 30%. Japanese group is at 10%. This property is located almost straight between the McArthur River Mine and Key Lake Mill. It's literally off of the Hall Road Highway and the power line that connects Key Lake up to McArthur. I call it Main Street. It's Main Street because there's really only one street in the Athabasca Basin, and we drive on it and make a left turn and we're onto our property. We've got it's two deposits there. One of them is Phoenix, which is really well known. You're talking over 70 million pounds at an average grade of over 19%, highest grade undeveloped uranium deposit in the world. And a second deposit just shy of 3 kilometers away called the Griffin deposit. It's a basement-hosted deposit, 43 million pounds more at an average grade of 2.3%. Together, we've got critical mass. We ran a PEA on this project early in 2016. We ran it at $44 uranium, which was the long-term contract price at the time. Almost nobody uses the current price deck when they run their economics. We did it because we wanted to prove that this is the next developable asset in the region, and we've done that. Cameco is not moving their assets. They've put projects like Millennium on hold. Areva, who's our partner up at the McLean Lake Mill, they don't have assets that are really being advanced. And so there's only one real development asset that's moving forward in the eastern Athabasca Basin. It's Wheeler River. We already own 22.5% of the McLean Lake Mill. Our PEA assumes that we're going to toll mill from Wheeler River up at McLean. It's a mill that already exists, already has excess capacity, it's already licensed. This is a low-risk proposition in the grand scheme of things, and that's why we're confident to say that we're positioned as the next producer in the region. And I think that's what we're really trying to focus on with investors, is that there's that massive void between Cameco and Paladin, and imagine the torque that you'd get out of a story that investors could really see as the next producer. That's where we've gone with Denison, and it's been a bit of a ride to get there, but I think we're really doing quite well on that path.
The inability to find an intermediate producer outlines just how volatile this uranium stock market can be when capital rushes in. And as an example, Denison Mine, which trades on the New York Stock Exchange under DNN, or the TSE under DML, currently trades around 50 cents, but traded as high as $15 within the last decade. Question for you, as you're trying to develop here, how do you balance the potential dilution? Of course, you have need to raise capital to move things forward, and the progress that you're trying to achieve.
Well, great question, Colin. Dilution is a bit of a dirty word around here. We have a large shareholder in Lucas Lundin. He's the chairman of our board, and one thing that we're constantly conscious of is that shareholders don't make money if they don't own a good chunk of the company after you get through tough times. And Lucas is a vivid example of a person who cares about that. So our company is really well positioned because we do raise money for exploration. We've used the flow-through share market in Canada, so it does allow us to raise money at a premium to the market. But we're not reliant on that market. And I say that because we've got sources of internal cash flow. And this is a really unique aspect of Denison that you won't see out of most developers, and definitely out of no explorers, is that we actually generate, call it $8 to $10 million a year internally. And we do it from three main sources. Number one, the fact that we own 22.5% of that McLean Mill. The mill is processing 100% of the ore from the Cigar Lake mine under a tolling agreement. And we'll earn, say, $6 million a year in tolling revenues for the next several years from that operation. That's a free cash flow to Denison. Tack on top the management services fee and the income we earn from managing UPC, and tack on another, say, $1 million to $1.5 million that we earn from an environmental services business that we run up in Elliott Lake. You're generating, again, $8 to $10 million in cash flow internally. So when we go to raise money, we're raising just the increment for our field work and our exploration in the Athabasca, and we're comfortable with that. We're not overly diluting. We're looking in that 2 to 3% dilution range per year, which is really a reasonable carrying charge. But what we're doing is we're deploying it 100% into the ground and adding value with it. None of that's really going to pay the carrying charge of keeping a development company going. That we're paying from our own cash flows. So that's how we're looking at it. But we really are conscious that dilution in a negative market or in a down market is a really dangerous thing, and we're always on top of that, trying to minimize the impact.
David, thank you for taking the time to share your thoughts today. You're quite the busy person, being the president and CEO of two companies, and of course the last week and a half has certainly added to your busy schedule in a very good way. Hopefully this will be the first of many interviews over the coming months and years ahead, and of course hopefully uranium markets look more and more positive as time develops. Thank you very much for coming on the program with us today.
Thanks so much, Colin. We appreciate the opportunity, and we'd love to keep it up. And the reality is, you have a positive view on the uranium space, and I think that's smart. We really do believe that this space is poised for a major turnaround, and we think our two companies that we're representing are really well positioned to be a top choice for investors in the space. But thanks very much again. Appreciate the opportunity.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw material. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?